financial trends you should be scared of in 2022.
It's Brian Preston, the money guy.
Yeah, Brian, I am excited about this show because I always love when we can educate our audience on like things to be aware of, things to like keep your eyes on to protect you from making less than ideal financial decisions moving forward.
I'll be more blunt.
Oh, okay.
Age creates wisdom. Experience creates wisdom. Yep. And I see so many things going on right now that I'm like, uh-oh, let me get my popcorn because this gets really interesting. That there's a lot of things that I think people who are kind of new to this concept of investing, you need to be aware of, and that's what we want to kind of protect you of so you can go ahead and know how do financial mutants process things when we're experiencing right now coming into 2022.
So what we're going to do is we're going to walk through sort of 3 specific trends that we think that you should be aware of. And if you start noticing these things happening in your world, red flags should go off. Lights should start blinking. And the first one is one that you may not be thinking about, but it is a very real risk and a very real issue to a lot of wealth builders. And it's over-concentration.
But I want to give you credit. We did a Q&A show not too long ago, and one of the people had asked a question about Bitcoin, it was Bitcoin, because I was thinking, was it AMC, was it Tesla? It was Bitcoin. And he said, hey, look, I want you to make sure you've done all the other steps before you take the going in over-concentration into Bitcoin. And I think that is the biggest thing that I see a lot of people doing is that they've gone ahead and skipped index funds.
That's right.
Index funds, that's for your grandparents. That's what they're thinking. And they go right into whatever the latest, greatest trend is, whether it's Bitcoin, one of the Reddit board stocks like AMC or GameStop, or even, you know, I love me some Tesla, but that's even on this over concentration. So we want to kind of do an exercise.
And what we're saying is we're not saying that in and of themselves any of these things are necessarily bad. Brian, you already alluded to getting it out of order is bad. Doing these things before you've built some base level solid foundation is bad. And as well as putting too many of your eggs in that basket can be bad, and we're going to show you why. We're going to walk you through why that can be bad.
We got better than a while. We've got an illustration because we love to do this the Money Guy way where we go beyond common sense and actually show you some things. So first thing, we have a chart for you. And I want anybody looking out there, if you're out there in YouTube world, you can see it. But unfortunately, our podcast people, we're just going to have to describe this. I'll give you the Howard Cosell on it. And the fact is that we've got, we don't know if it's Tesla, Bitcoin, AMC.
But it's like a growth chart.
I mean, this thing, you're very happy. If you bought on the left side of this chart, you are so proud of yourself because, I mean, this thing's looking like it's probably at least a 10-bagger on how much money you made. So you've made at least 1,000% on your investment.
And so the question is, okay, which one of these companies is it? Is it Tesla? Is it Bitcoin? Or is it AMC? You may be surprised to find out that the actual answer is none of these 3.
Yeah.
It's actually a different company. And I'd argue for a lot of our audience, thinking about the demo in which we work, a lot of you may have not even heard of what this company is or what this stock is.
Yeah, and this is, like I said, wisdom comes from experience. So as a young financial advisor, I worked with a lot of executives for this company. This chart that we're showing, we'll go ahead and show you the rest of the picture, is Lucent Technologies that were headquartered in Atlanta, Georgia. I was working for a fee-only firm that we worked with some of those executives. And this is the thing that I think people ought to be nervous about. You think, and look, we love some of these companies. Like y'all know I love me some Tesla, and you see how well Tesla's doing. Lucent Technologies was the 7th largest company in the United States in the year 1999.
So it was like a household name-esque company.
If you were an investor back in 1999, you knew about Lucent. It was very similar. Like I said, the 7th largest company in the S&P 500 at the time. That's pretty powerful. But here's the rest of the story, as you can see from the chart. It got to a high of $130 a share, and then within just a few years later, it was trading at $1, or actually less than $1.
So I want you to think about that. If you owned a share of this stock at its peak, it was worth $130, and just a few years later, it was worth cents pennies, less than $1. Imagine if you didn't just hold one share of stock. What if you held 100, 1,000, 5,000, 10,000? What if the majority of your wealth was held inside of this company? Your overall total wealth would have been absolutely decimated if what happened to Lucent happened to your portfolio.
So we wanted to kind of go a step further and look at the charts for, let's look at some of the things that are household right now. Everybody's so excited and they think that, hey, this is what you should be doing. Why should you diversify? Why should you do index funds when you can just go buy Bitcoin? Now, look, it's had volatility. I don't even think this chart shows that we went from 60 to mid 40s within we went bear market status in less than a week. And then I saw today we're back in recovery mode. This thing is all over the place, and we don't know what the future holds yet.
Look, you can't argue against the fact that the trajectory of Bitcoin and the performance it's had to date has been meteoric. It's been unbelievable, out of this world. And we're not saying that that won't continue because nobody knows. We don't know if Bitcoin will continue to move in that direction. Or maybe even if we look at a different company, a company that's near and dear to our hearts here at the Money Guy Show, you look at Tesla.
Yeah.
If you look at what Tesla has done since January of 2020, all the way through the end of 2021, it's been a fantastic ride. And shareholders and participants in that company have been rewarded for that. What we don't know is what the future looks like. We don't know what the next 1, 3, 5, 10, 15 years for any of these individual holdings or individual companies might look like.
So I'd like to pivot because, like I said, you even said it earlier. We're not against any of these investments.
Not at all.
But we do need to make sure we have the right mindset. What would a financial mutant do? And I think this is so important when you're talking about specifically over-concentration. Because how do you get to over-concentration is where you're just loading it up into something. So here's some things we put together. First, ask yourself, are you investing? Are you speculating?
Now, here's what I think is really interesting, Brian. I know a lot of folks who have waded into the Tesla waters. I'm going to use that as a specific example because they've heard of what's going on and they heard about the rise and they saw the 1,000% return and fill in the blank. They know nothing about the company. They know nothing about the product. And they know nothing about the fundamentals. I was there with you when you placed your very first purchase of Tesla stock, and it had nothing to do with what the stock price was doing. It had nothing to do with how well the market performance had been. You said, Bo, this car is amazing.
It's going to change the world.
It's going to change the world. I love this product. I love this company. I love what they're doing. I'm going to invest, keyword being, in the future of this company, not speculate on what I think the stock price specifically might do or might not do.
Yeah, and I think that's the key part is that I was investing. I told you at the time got my first Tesla, and then I drove it, and I was like, this is the
insane.
best car. I mean, so I immediately went out and bought some shares of Tesla. This was back in 2018.
Yep.
And then you're right. I've kind of stayed the course, been through thick and thin, because I am investing. I'm not speculating. This is not a momentum trade. And that also leads to the next point that I think is very important. You want to make sure your individual exposure is less than 5 to 10% of your portfolio. And even though Tesla, for me, I mean, we've got to be getting close to a 20 bagger at this point. I mean, we're almost at 2,000% on that initial investment, but it is still less than 10% of my total portfolio.
So I want you guys to hear that. It's okay, assuming you have a foundation in place, if you want to do some speculating, but you have to be aware of that. But let's say that it works, and let's say that it hits, and let's say that you did get on Bitcoin, and let's say that you did hit Tesla right, or maybe you were on the Reddit boards and you rode that wave. You need to constantly be making yourself aware, is this more than 5 to 10% of my overall portfolio? And if it is, you are rapidly getting to that place to where you are over-concentrated, and the risk inherent in that holding, just like for those Lucent executives, might not warrant your participation in the way that you are participating. And so a lot of folks might say, well, guys, I'm not an investor, I'm not a speculator, but I work for this company, and a lot of my compensation comes by way of options or by way of RSUs or ESPP. If you can't control keeping your exposure below 5 to 10% because of one of those factors, you ought to at least have a strategy of how you're going to get back there. And we've even seen this with folks who said, you know what, guys, I took 5% of my portfolio and I bought Tesla, but then it turned over 2,000%, and now it's way more than 5 to 10%. Okay, that's great. let's come up with a very tax-efficient, risk-mitigated strategy on how you correct that moving forward. Don't just kind of put your head in the sand and ignore what has taken place in your portfolio.
I let it be clear that earlier we worked with some Lucent executives at my former company. And here's the thing. I think that a lot of insiders, when you care about a company or on the inside of a company, you're a perma bull. You just assume things are always going to be good.
Right.
Even though you're an insider, that does not necessarily mean that you have it all figured out on where things are going. So what I like, the key word here is strategy. Just like we dollar cost average into holdings by buying monthly over time, you can do the exact same thing when you're trying to diversify out of a holding. You can dollar cost average on your liquidation of that too. So you can do exactly what you said. Take advantage of the taxes and make sure that you're building in, how do we do this in a strategic way so that I respect what I think is going on with this company, especially if you work there, but how do I make sure I'm building wealth outside of this company as well?
And look, we've even had this happen. Someone says, hey guys, I've got this going on. I bought this thing. It did well. I've got 20%. I'm in a high tax bracket. It's 20% of my portfolio. I cannot sell it. We say, hey, great. You know what we're going to do? We're going to save so aggressively in the portfolio that you are going to dollar cost average up the value of your portfolio so that 20% holding comes down to 5 to 10. That is an appropriate strategy to mitigate that risk, because over-concentration feels great when it's working, but it can be absolutely devastating when it goes awry and moves in the wrong direction for you.
I want to move to number 2.
Okay.
Now, I feel guilty about this one a little bit, Bo. This is the Doomsdayers. Now, look, Daniel took some liberties here, and he pulled like a Mad Max-inspired
like a nuclear Holocaust survivor.
It's crazy what he found here. But here's the thing. We just coincidentally, I think this was in the last 2 weeks, we had a show premiered on a Friday, which was a day the market was off like 3 to 4%. Sure. So, and it was a show on how to deal with market volatility. So it had some clickable headline.
Timing worked out pretty well.
But this is the problem. I felt like on that day that show premiered, we probably looked like we were a doomsdayer because of the timing that show. And there are plenty. I mean, there are so many people out there telling you, oh, man, it's going bad out there. You should just head to the hills, be scared, buy our seed bank, buy our newsletter, buy gold, buy Bitcoin. There's all kind of products and things that supposedly will mitigate this if you'll buy somebody's system. You've got to be careful because a lot of times these people will hold up that they called the last one. The problem is they've been calling the downturn every year.
That's right.
Even a broken clock is right, twice a day.
That's
so,
right.
I mean, that's the same. So eventually they might be right, but they don't really have any idea when the timing of bad things is really going to happen.
And look, don't just take our word for it. We'll actually show you some examples. If you go back to August of 1979, there was a Business Week magazine that came out, and the cover story was the death of equities. We had double-digit interest rates, and inflation was going crazy, and there was oil stuff happening. And it was a trying time in the economic system at that time. And so if you were to read this and you were to have acted on believing that equities were no more going to be a thing, what would have happened is over the next 12 years, the S&P 500 annualized 17% per year from 1979 all the way through 1991. You would have missed out on that had you acted on the media's interpretation of what the future was going to look like.
Now, look, that's 1979. There's only one of us here that was around in 1979. So do you have something even closer or newer than that?
Yeah, let's go back a little more than a decade ago to October of 2008. This is a cover of Time magazine, and they titled it The New Hard Times. Now, they took some creative liberties here because if you're out listening on Spotify or iTunes or iHeartRadio, they have a picture. This has to be like Depression era, soup kitchen, soup line in 2008. But they're basically saying, guys, future looks grim. This is not going to be good. We're about to go back into a Great Depression-esque era in this country.
Here's what I think is interesting about this, Bo. 2008, we were working together.
Yep.
But this was the big one, your first big one.
Yeah. Oh, yeah.
First big one.
First big one.
So I told you when we were going through this together, I said, Bo, I want you to bottle up this lesson. You are getting the best education in investing right now, because what you're experiencing emotionally and all the things that are coming at you with the news media telling you, oh my goodness, we're going to be in soup lines. You know, we're not going to ever recover.
New paradigm.
This is the type of stuff that they try to put out there and scare you to death. And it really was a valuable education.
Absolutely.
Because what happened over the next 11 years?
Over the next 11 years, if you just look at the S&P 500, it had annualized return from 2008 all the way through the end of 2018 of 14.7%, almost 15% per year, coming out of the Great Recession when everyone was saying things are going to be different, things are going to change, hard times are coming.
But let's be honest, 2008, I mean, we're getting close to that being 14 years ago. Technology's changed.
Yep.
We got the internet's proliferated. We all have so much power in our pockets now with our mobile phones. Surely we've gotten better at it, because this cannot be an age-old problem. This has to be something that was a yesteryear problem, but technology solved it, right?
That we fixed, right? So now, okay, let's look at more recent data. Let's look at headlines from the end of 2008, the Great Recession, all the way through 2021. And if you go pull these, you see headlines like, the risk of a double-dip recession is rising. Uh-oh, here comes the recession of 2011. Oh, America's big banks are predicting recession. 6 signs we're close to the next recession. Wall Street thinks a double-dip recession, so on and so on and so on. But if you can actually see this on the screen right now, we've overlaid the S&P 500 from the end of the Great Recession all the way through 2021, and it's been a steady walk up the mountain, even though people have been predicting the next recession or the double dip or the downturn the whole time. Eventually, one of them will be right. The question is, when will that take place, and how long are you willing to risk being on the wrong side of that, when history generally rewards people who stay consistent?
Well, I want everybody to hear me clearly on this, because you've heard me. I was tongue was firmly in my cheek when I was saying, surely they fix this through innovation, technology, because we all know we live in this great, awesome world where things are getting easier or better through innovation. But here's the reality of the situation. The people who are in charge of the news, the financial news, they don't want this to get better. And there's a reason, there's a human element to this all. Fear will help sell products. Fear will keep your attention so that you'll actually watch the news media. They want your ears. They want your eyes. They want your attention. They could care less what's going on with your wallet.
That's right.
So I want you to learn a very valuable lesson. The financial media is more concerned with your eyes and ears than they ever are about your financial well-being as a household. So there's a lot to learn from that statement. So please make sure you interpret how fear is used to sell like life insurance, how fear is used to sell advertising, how fear is used to keep your attention through typical media. That right there could be a show on its own. Don't fall into that. So I think we need to pivot now from the fear element to the preparation side of things so we can actually do this right.
Yeah, what I think is great is the financial media, Brian, they don't want to prey on your emotion, right? That's what they want us to do. They want us to be emotional creatures. Well, we at the Money Guy Show like to use facts and data.
It will inoculate you from this whole emotional play.
That's exactly right. It will protect you, because one of the things that it would probably make sense for you to be aware of is how often do market downturns happen? How frequently do they take place? So we actually went and pulled the data that we can share with you.
So here's what's cool. I mean, look, we just had a week. It was within the last week and a half, the market got beat up for like 3 or 4 days or whatever. There it is. The market falls by 5% every 1.1 years.
And by the way, this is from data that dates all the way back to 1928 through 2021. So we have a large sample of data, almost 100 years here, to see how often do these types of pullbacks happen.
I mean, a 10% downturn in the market's going to happen every 1.6 years. That's pretty common, by the way. You don't invest in the financial markets unless you can let go of it for 5 to 7 years.
That's right.
So you just go ahead and know if you're going to be an investor, you're going to experience 5% downturns. You know you're going to experience 10% downturns. You know you're going to experience 15% downturns because they occur every 2.5 years. Yep. A 20% downturn, officially a bear market, occurs every 4 years. You hear that? You're not even long. We haven't even reached long-term status yet. 30% every 9 years. 40% losses every around 20 years. And then markets can lose about once a generation, every 50 years, about 50% of their value. It's better if you just know those stats so you can kind of figure out how you're going to handle your emotions as you decide, hey, you know what? I want to be an investor. I've heard these guys talk about my army of dollar bills, the power of compounding growth, but you don't step into that investor shoe unless you know you're willing to also put up with this volatility.
Yeah, and I imagine how much different would it be if the headline said, everybody beware, we might have a 5% pullback. Everybody be careful, the next 10% downturn is coming. That's probably the truer story than here comes the next recession. Here comes the next giant downturn. So if you can approach your portfolio in that manner and recognize how to block out all that noise, you are going to set yourself up to act differently than the masses, to act differently than the average investor and be a true financial mutant.
I always think about the fact that when we talk about the financial order of operations, go to moneyguy.com/resources. Do we focus so much in the beginning of the financial order of operations on making sure you have some of the basics covered? And a lot of it is because we don't want you making that knuckleheaded, like I'm in a horrible situation because I don't have cash, I'm emotional. You know, it's when you make those catastrophic decisions that you're desperate is when you make bad decisions. So we're trying to help you be prepared so you can take out the anxiety, you can take out the fear, and you can actually anticipate, plan, and actually have the resources to make sure you don't derail your financial life just because you're desperate and you make a bad emotional decision.
So if you're sitting out there listening, okay, if I'm a financial mutant, what are some of the things I would do? How do I accomplish what Brian just said? Step number one, have emergency savings. If you have cash on the sidelines, you have your emergency fund. If the market loses 20%, you don't care. If the market loses 40%, you don't care. If you lose your job, you don't have to go sell, even if it's in the middle of a recession, because you know you have your emergency fund to protect you from that. It's the reason you have it in case an emergency happens. So if it's there, you don't have to be scared of emergencies.
Because the next one is dollar cost averaging. What I like about dollar cost averaging is it exploits how odd us financial mutants process the world. Because what happens with a financial mutant, if you know you're buying every month, if you do hit volatile periods, instead of being like, oh my goodness, I can't believe how horrible this is, look how much money I'm losing, your brain flips a switch and you go, holy cow, I get to buy in at a cheaper price. Everything's on sale. I'm so excited for what this means for my future self. That's why I like having strategic, timed purchases through dollar cost averaging, because it helps you emotionally smooth out that volatility.
And then I think the third thing that you can do is remember what those investments are for. I have a lot of friends who know that I'm a financial advisor, and when the market has some volatility, they'll say, oh, Bo, you see what the market did today? Are you worried? I'm like, worried? I'm not retiring for like 40 more years. No, I'm not worried. I know that the dollars that I'm putting into my army of dollar bills are dollars for future Bo, not today Bo. Well, when you think about your portfolio, you ought to think about what portion of my portfolio is for the next 1 to 3 years. What portion is for the next 3 to 7, 7 to 15, 15 and on. If you can construct it that way, and you know you have long-term money sitting there, you shouldn't care about the day-to-day or maybe even year-to-year fluctuations, because you know the game is the long-term, not the short term.
I mean, you say it, we say this quote all the time. It's not timing the market, it's time in the market. And that's something we've done so much research, and we've done shows on volatility where we will show even somebody like from Back to the Future, Biff with the Sports Almanac, even if you could nail buying in at the perfect time, you'd be surprised to learn that you're actually better served just buying consistently, driving through it. I always make the Days of Thunder reference because that was my, what was influencing me when I was working at Hardee's back in the day, is that you just drive through it. Even though when you're going through volatility, you see smoke, you see fire all around you. Keep buying, dollar cost average, keep your emotions in check. Know what the why is on every pot of money between 1 to 3 year, 3 to 5, and then 7 and beyond. You will be protected and you won't make those desperate, bad emotional decisions.
The Doomsdayers are going to tell you the next thing is coming, the next thing is coming, and eventually they might be right. You just don't want to be the person who keeps getting it wrong, who keeps being on the wrong side of that. So if you can have a plan in place and block out the noise, you're going to do so much better at setting yourself up for success.
Let's talk about number 3, which is forgetting what you know to be true.
Yeah, again, we are emotional creatures. And when things happen that are unexpected, that we're not thinking about, that we're not really front of mind, it causes us to freak out. We just have sort of like this fight or flight mentality that exists. That's no different with our finances. So when the downturn happens or when the optimism happens, when the euphoria happens, we have to remind ourselves, no, there are some tried and true tenets to building wealth, and I need not forget those lest I take myself off course of my wealth building journey.
So this isn't even that old. We created a new deliverable to go with an awesome show we did called The 10 Commandments of Creating Wealth.
Yep.
And I would encourage everyone go out to moneyguy.com/resources, download this brand new deliverable with all 10 of the commandments. And one of the ones that stands out to me is number 8, which is don't take shortcuts. Because here's the thing, guys. You're going to go through periods, and after you read these 10 commandments, and I want to just prepare you. Whenever we face volatility, market downturns, bear markets, I want you to pay attention to some key words that you'll hear coming out of talking heads on TV, the financial news media. If you ever hear the word new paradigm.
Ooh,
we've never been here before.
That's a spidey sense.
I want you to, I smile. I've gotten to the point where it's this is financial mutant territory where I smile when I hear somebody say, well, it's never been like this before. We're in a brand new paradigm. I'm like, oh yeah. God,
prepare for pie on your face.
It's just one of those things you just, bless their soul. They just bless their heart. And if you're a good Southern person. The other thing that I see recently is, hey, you just can't lose. I mean, forever in 2008 and even before, you'd hear people when they talked about real estate be like, God ain't making any more land.
Can't go down in value.
Can't go down in value. Like famous last words when you speak in absolutes like that.
I feel like if you just scroll through any of our YouTube comments, you will see all this about Bitcoin. You're going to be sorry. If you're not on Bitcoin, you're missing out. It's the only way. It's the future. It's the fill in the blank. Nobody knows. Nobody knows. And when people start telling you there's only one answer and it's the absolute answer, and if you're not on it, then you're going to miss out, you should immediately start to be thinking, oh man, who is this person? Where is this source coming from? Is this someone I should be listening to?
And another big thing that I think is so important is cash, the power of cash. I see all over social media right now because it seems like money feels easy between the Bitcoins, the Teslas, and all the things that are pulling your attention right now. I've seen people that I think are very smart, and I see them post on social media, hey, I'm thinking about taking my cash down to $3,000 so I can let every dollar go to work for me. I always know that's so dangerous because what you need is, look, when things get desperate, when it goes bad, I showed you how often bad timing of markets can occur and when those downturns are. You have to understand liquidity in cash is like oxygen.
That's right.
We all take it for granted so much that you can breathe, you can exhale, and you're like, oh, what's the big deal about oxygen? Just go underwater and see how much you appreciate having oxygen. Yep. And it's the same thing with cash and liquidity. Why do you think Warren Buffett always has enough cash to bail out all these companies? Because he gets the best of the best deals. That cash not only, yes, I get it, interest rates are low right now, but cash done appropriately can be tremendously valuable if you are using it appropriately, and it also keeps you from making those desperate emotional decisions that will derail your financial life. respect the value of having liquidity.
You know, I think one thing that's so interesting about wealth building, and it's actually one of the 10 commandments, is that it's surprisingly simple. It's not incredibly complicated, but it's not always easy. And a lot of times, the not easy comes in different forms. Perhaps not easy is, man, the numbers have just gotten so big, and I've been making good decisions, but man, you know, if I made a boo-boo on $10,000, oh, it's not that big of a deal. But make a boo-boo on $1 million, I'm starting to have a problem. Or maybe not easy as, you know, I've got family commitments and I have work commitments and I have community commitments, and I just don't have enough time to be able to put my financial affairs in the forefront. They end up falling on the back burner and staying on the back burner and staying on the back burner. That's one of the things that makes wealth building not easy. Or maybe you just don't know what you don't know. You know, you used to be able to just go to TurboTax and fill out your tax return, no problem. But now you have options and incentives and K-1s and real estate. And you have all these different things. You're like, man, when did my financial life get so complicated? One of the things that you can remember is it's not always a bad idea to ask someone to come on and help.
Yeah.
So reach out to a co-pilot to figure out, is there someone who can help me navigate these new things that I'm facing?
Yeah, and graduate and take the relationship to the next level. We always are talking about the abundance cycle because you come here, we just give it away. We load you up with tons of free advice. Yep. We want you to learn, apply, grow. But there will come a day you're going to be successful because everything we do, wealth is surprisingly simple, but so far from easy. But we're going to help you get to that point, cut through the clutter, see through the smoke that the consumer world we live in creates. But you will have that moment of success. And all those things that Bo described, you're going to remember who planted those seeds, who helped start your growth. And we really do hope you can either go to aboundwealth.com or you can go to moneyguy.com. We have a work with us page on every one of those websites. That's how you pay it forward. That's how you pay us back for all the free advice, is because we truly believe that you cannot outgive having an abundance mindset.
Now, I think what's so interesting in the financial world, Brian, is that history has a way of repeating itself. You know, we talk about overconcentration. It happened in the late 90s. You lived and managed through that. And then we saw it happen again, or we're seeing things that might be happening again now. We saw Doomsdayers back in the 70s. We've seen Doomsdayers in the Great Recession. But we see Doomsdayers even now. It's happening over and over again. And oftentimes we forget the things that we know to be true, that living on less than we make makes sense. Saving money for the future makes sense. Covering our risks makes sense. It's easy for history to repeat itself and us to forget those things. But don't you worry, we're going to be your team that's going to help keep that on the forefront. We're going to keep doing the show. We're going to keep preparing deliverables. If you've not gone to our website, go to moneyguy.com/resources. We have a ton of free resources available to you that you can use to take your finances to the next level so that you don't get caught up in whatever the next financial trend is that trips up all your peers and all your coworkers and all your family members. You're going to remember, no, I've got a team in place that's going to help me continue to get on and past that.
I did think of one more ask on the abundance cycle.
Okay.
We have, in addition to work with us, if you go to our website, we also have a careers section.
Oh, good one.
Guys, we're growing. I mean, we've been making some lists. We've been featured in some stuff. We're trying to grow the team. If you watch this, you're a financial mutant who already works in the financial space, go to our website. You owe it to yourself. I think it's one of those things where not only are the best clients from the Money Guy Show, our best employees are also from the Money Guy Show. This is the gift. I think it's providence. I think it's the abundance cycle lived throughout. You too can work at Abound Wealth, and we can create prosperity together. I love creating content. We love doing great things for not only our clients, but our employees. We're going to keep coming at you with all this information. I would invite you to go on this journey with us. I'm your host, Brian Preston, Mr. Bo Hansen. Money Guy team, out.